Good afternoon, everyone, and thank you for joining us. I'm Sarah Campbell. I'm USDA's Beginning Farmer and Rancher Coordinator, and welcome to our webinar on tax considerations for agritourism operations. Before we get started, just a few housekeeping items for folks. This webinar is being recorded and it will be posted online. You can find all of our tax materials and a lot of really great information on farmers.gov/taxes. If you've got questions, drop them in the Q&A. We're going to have a robust discussion at the end after we get through the presentation, but this is being recorded and you will be able to, it takes us a few weeks to get it captioned and posted online. But you will be notified once everything is done and available online and the materials are available for download. So don't worry if you joined late or maybe didn't catch something, you'll be able to revisit all this content. And we have also at USDA partnered with the National Farm Income Tax Committee. So we work with experts on ag taxes from around the country, including our presenters today, Kevin Burkett from Clemson and Rob Holcomb from the University of Minnesota. And they're going to be talking about tax considerations for agritourism operations, which is a really important and timely topic as agriculture is changing a lot and a lot of farmers are doing more than just producing crops or selling farm products. There's a lot of different ways to bring revenue to your farm operation, but with that comes some additional tax considerations and complexities. So without further ado, I'm going to hand it over to Rob and Kevin.
All right. Well, thank you, Sarah. Just to do the introductions here, Kevin, you want to lead off with the introduction, and then I'll just kind of do mine and take it away with the first segment.
Yeah, that sounds good. And our names and everything are listed there, but I'm Kevin Burkett. I'm an extension associate with Clemson University, so work in the area of farm management and taxation and work with our Clemson Tax Schools, which is a continuing education program for tax professionals around South Carolina. But Rob and I serve on a couple different committees together regarding farm taxation and educational programs around farm taxation. So we were at a meeting a couple weeks ago, and we're doing a pre-conference on agritourism, and felt like this would be a pretty good area. Seems like an area where a number of questions come up, and there might be some confusion. So felt like doing a short webinar on some of this information would be helpful and timely. So hopefully it is.
Okay, well, thank you, Kevin. And I'm Rob Holcomb. I'm an enrolled agent. I'm also an extension educator with the University of Minnesota Extension. One of the other hats that I wear, I happen to be the tax school director for the university tax courses that we offer through the University of Minnesota. And as Kevin mentioned, we serve on a couple different national committees that deal with tax issues. So, folks, we're scheduled today for a 90-minute segment, and what we'll try to do is we're planning to do the presentation and allow some time at the end for some questions. What we are going to do is we are going to what we ask everybody to do is hold the questions till near the end of the program. What we've learned in previous webinars is that oftentimes the questions, when people ask a question, it very likely is going to get answered inside of the next 5 minutes. So, I guess we'd encourage everybody to listen to the presentation. If you got a question that pops up, jot it down. We'll engage with that Q&A near the end. So, with that, Kevin and I, one of the programs we work with is we work with ruraltax.org. Now, this is also known as the Publication 225 Committee, but in fact, Kevin and I were in Washington, D.C. last week, meeting with a variety of entities. We met with IRS and several other federal agencies, reviewing the contents of the Farmer's Tax Guide. Plus, we also work as a committee to populate this ruraltax.org website. Now, this is hosted through Utah State, but if you go to ruraltax.org, you can get there either, the web address is ruraltax.org, or you have the QR code there. But there's a wide variety of fact sheets that are posted on that website, and I won't read the list here, but there's a wide variety of fact sheets and resource material that happens to be posted there. Much of the material that we're going to present today was drawn from the material that's posted on ruraltax.org. And also need to mention that that is also funded through a USDA grant as well. We've got our standard disclaimer for the USDA program, because this is a USDA funded activity. Also, folks, we want to also emphasize that the content of this webinar is neither tax advice nor legal advice. It's more of an educational nature. So I always encourage folks, check with your tax accountant and your tax professional when you're making any of these decisions related to what we're going to be talking about today. In fact, all of the programs that I do tax related here in Minnesota, I have a slide specially prepared with a big stop sign that says "Be a good consumer of professional services," and that pretty much covers everything that we're going to want to talk about on the disclaimer. So let's dive into the material here. Here is the when you go to the landing page on ruraltax.org, this is what it looks like, and you've got a variety of hyperlinks to those various tax topics, and there's a variety of fact sheets that are available, and those are updated periodically. Plus, we also advertise upcoming events that are co-sponsored with USDA as well. All right, so our agenda today. Let's kind of dive in here a little bit. What we're going to start off on is, our topic here is that challenges of agritourism, pretty much from the income tax standpoint. So the whole premise of this, folks, and you're going to hear this over and over again, is if you have an agritourism operation, you very likely have a portion of the operation that is farm income. And you also have a portion of the income that's going to be non-farm income. And that's largely what we're going to be differentiating during this program. But first, we're going to define agritourism, and we're going to talk about what is farm income from a tax standpoint. All right, because farm income can be defined a number of different ways. All right, what's a non-farm commercial activity, and how do we differentiate those two? Give you some overview on reporting for tax purposes, and we'll also talk a little bit about why that separation matters. All right, and there's some big reasons why we've got to be able to split that stuff out. All right, we'll also talk a little bit about tax and legal risks if you don't get that split out correctly, and we'll also talk about some best practices and wrap it up kind of with some case studies and examples. And we've got a little bit on some record keeping hints at the very tail end. So let's kind of dive into the material here and look at this definition. And this is not out of Webster's or anything like this, but agritourism is essentially any of those activities that combine a traditional farming operation with some type of tourism activity, maybe a farm stay or a corn maze or a U-pick operation, or maybe a farm to table event or an educational tour. I'll mention this several times during the webinar. One of the, I live in southwestern Minnesota. A very popular agritourism thing in this part of the country are apple orchards. And what they do is they open up the apple orchard in the fall. They sell apples. Some of them charge admission, but they also do hay rides. They might have a playground for the kids. They've got a gift shop where they'll be selling apples. They also might be selling pies and jams and jellies and all that. And a portion of that is farm, and a portion of that's non-farm, and that's largely what we need to talk about here today. All right, let's advance that. So the reason why we have to be able to differentiate these things is, there's tax, legal, and operational implications for being able to distinguish this. And one of the main reasons that we have to do this is farm income gets treated differently on the tax return than non-farm income. All right, if all your income is from a farm, there are that. Let me take a breath here. Farm income, if 2/3 of the income from the operation is from a farm, well, that changes our need to have to do estimated tax payments on a quarterly basis. All right, because a farmer under meeting the IRS definition doesn't have to do quarterly estimated tax payments. So it affects that. It also, Kevin's going to talk a little bit later on income averaging. You can only do income averaging with farm income. Also, if you've got an operation where you may have some soil and water conservation expense, we're only able to take that on the farm portion of that as well. So those are just a few of the things that are going to be affected. Plus, Kevin's going to touch on the payroll aspects of this as well. We have to, because we have to treat the farm payroll differently from what we have to treat the non-farm payroll. All right. So, for what is a farm for tax purposes? Farms are, when you look at this from 30,000 foot level, you would think that it's not that hard to define a farm, but it actually has a variety of definitions. So, IRS and Treasury is going to essentially say that a farm includes livestock, dairy, poultry, fish, fruit, truck farms, plantations, which is a tree farm, ranches, ranges, orchards, and groves. All right, we've got to be involved in cultivation, operation, and production of product for a profit, either as an owner or a tenant. We don't have to necessarily own the ground that we are producing it on. We could rent it, and we could still be classified as a farmer. Let's move on here, Kevin. So farming activities, this one defines it actually a little bit better by example. Now, farm income on a 1040 tax return is reported on Schedule F. Once again, farm income gets reported on Schedule F. And farm income is going to include if you're growing and selling livestock, grain, horticultural crops. If you have crop insurance proceeds tied to a crop that you're growing, that's farm income, right? If you're enrolled in an agricultural in a USDA program where you're receiving an agricultural program payment tied to a product that you're growing, right? That is farm income. Patronage dividends. If you do business with a co-op, a lot of times the co-op will issue a patronage refund or a patronage dividend to the farmer. That also is taxable and is considered farm income. Custom work, it's customary, especially in my part of the country, that you might have a neighbor that may they may hire a neighbor to do a little bit of tillage or maybe some custom harvesting or something along those lines. That's considered farm. And if you're doing a lease based on crop shares, whereas the landlord gets paid to the portion of the crop, and they materially participate in the operation, that's also considered farm income. So largely what we're doing is we're producing a product in all of those particular items. Now, some things that we want to exclude. All right, if now, for instance, I don't farm. All right, I live in town, work for university. I have a garden in the backyard, but that doesn't qualify because it's all we consume everything that we produce. I'm not selling anything. All right, if I were to go and purchase a bunch of product and turn around and take it to the farmer's market here locally and resell that, all right, I'm not considered a farmer because I didn't produce it. All right, that the production aspect has got to be in there in order to be considered a farmer. Now, the other key bullet here that I want to point out is that anytime when I have that product that I'm selling, right? Farm grown product that is being sold. If we're taking any type of processing beyond the unmanufactured state, all right. The example on the slide here is like if you have a winery, for instance, where they have a vineyard where we're if we were to sell the grapes just as grapes, that's farm income. All right. But if we process it into wine and sell it as wine, that's not considered farm income because we've processed it. All right. Let's go back to that apple orchard example. If for instance, we had that apple orchard, sale of the apples is farm income. All right. But if I make pies, jellies, jams, if I process it and then sell it, that's considered non-farm income. All right. So again, if we're buying and selling items at a roadside stand, but we're not actually growing it, that is, again, that's going to be considered, that's not going to be considered farm income. Okay, let's advance it there. Okay, so on the farming activities, all right, here's where it gets a little more complex. If the farm, if we're selling farm grown products, like like we have a U-pick berry or pumpkin patch or something like that, that's all Schedule F. All right, because we're selling those things as we're not modifying it, we're not manufacturing it in anything else, we're not processing it. If we're selling berries, pumpkins, vegetables, corn stalks, if we're selling sweet corn or hay, that's all. We're not manufacturing that into anything else. All right, so that's all considered farm income. All right, and
You want
next
me
one.
to you want me to take it from here,
I
Rob?
think I'm just looking at my notes here, and yeah, I think that's it. Actually, yes. Go ahead, Kevin. Sorry.
Okay. And so I think Rob had already alluded to this and had already talked a little bit about the Schedule F. So somewhat easy to remember in our farming activities go on the Schedule F form. So you can find the form on the IRS webpage, just like any other tax form that you might be looking for. And within the IRS webpage, they're going to have the form itself, and then they're also going to have, typically on each form, you're also going to have a set of instructions. And so for the Schedule F instructions, it's going to be about 12 pages there, and it kind of goes line by line with you as far as what should be filled out on that form and maybe what shouldn't be filled out on that form. And it might make reference to another publication as far as making a calculation or reference some other material. But again, all of our actual farm production activities are going to get reported on that Schedule F form. Already talked a little bit about Pub 225, the Farmer's Tax Guide, and that's a longer publication, approximately 100 pages, but I would say if you have almost any type of question as it relates to farming and how your taxes may be impacted by your agriculture activities, chances are it's going to be covered in that publication. So it talks about your income and deductions and some of the special provisions that are available for agriculture. And there are a number of those to discuss and to talk about and think about. But chances are, again, if you have some kind of farming tax question, it's covered in that 225 Farmer's Tax Guide. One of our colleagues a couple years ago did sort of a line by line video series. These are short, I would say 4 or 5 minute videos. That's through Iowa State. You can see the link there, the interactive Schedule F. We will be sending a copy of this slide presentation, so I know a hyperlink in a presentation like this is not that helpful, but you'll have a copy of the slides later if you'd like to find that. Or also, I think a Google search would probably produce it pretty quickly as well. But kind of in the same vein of the instructions is kind of going line by line through that form, just to do a little bit of an explanation of what numbers should be there, what shouldn't be there, if there's a number that needs to go to another form or something like that. And just so you could kind of follow along and follow some of what we're talking about and maybe even look back at this past year's return or your past several years tax returns. So the Schedule F activities that we report on that form, they end up on another form, which is Schedule 1 of the Form 1040. And it ends up on line 6 of the Schedule 1, which is kind of a summarization of our activities for the year. And that's going to be on line 6 of the Schedule 1 of the Form 1040. So if you had agriculture activities last year, you filed a Schedule F, you should be able to kind of track this through your return. That's kind of why I was wanting to mention some of that. And so we'll get into it a little bit more, but we do see like our other activities, our value-added activities, our tickets and things like that, they're going to be reported on a different form. And you might think, well, couldn't it all be reported together, or wouldn't it be a lot simpler if it was all on one form? And while I don't necessarily disagree with that, there are a number of essentially special tax provisions that agriculture as an industry can take advantage of. And they're oftentimes very helpful provisions. And so that's why we see a separate tax form. That's why we sometimes see some separate calculations and provisions that are only available to our farming activities. And so those calculations, also we see sometimes there might be statistical analysis or something, and it might be based on the number of Schedule Fs that are filed. So it might be, say, USDA or some other organization is doing some statistical analysis based on those returns that are filed in relation to farm production activities. But if you meet with FSA or perhaps lenders or insurance, they might also request this form from you as part of their conversations with you, as part of a loan or a program or something like that. They may request that Schedule F form to verify your farm production. Now, I would say it's not always a great indicator of your true profitability as a farm, and I think that's an important point to make. But for tax purposes, it is the form that we file. It does kind of capture our information for the year. It's not always a great indicator of our actual profitability, but it is to report our agriculture activities for tax purposes. We're not really going to dive into this as part of this webinar, mainly because we had done a previous article in relation to it, and I believe one of our colleagues had also done a webinar associated with it as well. But Schedule J income averaging, it can be a quite powerful and quite helpful tax management tool, but it's only available for commercial farming and fishing operations. And so if we have quite a bit of farm income, Schedule J and income averaging is something we may want to take a look at, but our other types of businesses would not qualify for this type of provision. So it can be quite helpful. We're not going to discuss the details, but that's just one example of where we keep track of this information separately. We also have some additional tax rules and things that we can apply that a lot of times are advantageous for that purpose. And so I think Rob has already kind of alluded to several of these already, but if it's true farm production, we see it reported on the Schedule F. If it's really any other type of small business activity, and if we think about agritourism, the tourism is really what we're focusing on in that, or that's kind of what we're selling in those other instances. And so all these are good examples, not necessarily all inclusive, but gift shops, restaurants, it might be field days or a fall festival, amusement rod. Just generally they're coming out to the farm and they're enjoying something about the farm, but we're not necessarily selling farm products. And to be clear, there's certainly nothing wrong with any of these activities, whether it be hosting festivals or doing value-added products. And a lot of times we see it's sort of a natural extension of what the farm might already be doing, and it kind of makes sense that they might want to generate a bit more revenue or help their cash flow or something like that. But just want to make the emphasis and the point that it's just treated separately than our true farming activities. And so for the agritourism, it is going to be reported on Schedule C if you're a sole proprietor or a single member LLC, meaning you are the sole owner of that operation, and you are running it yourself. And so you are selling, in this particular instance, not a farm product, but you are selling, say, an experience, a service, a ticket, a value added product, or perhaps a craft. And again, that's probably not all inclusive, but those are the type of things that we tend to see as we talk about agritourism type activities or Schedule C type activities. We'll talk in just a little bit as well about what happens if it's a multiple member LLC, or if it's a partnership, or some of our different entity structures. But just to kind of get into the basics here a little bit. So as we already stated, the Schedule F is where we report our farm activities. Non-farm is going to be on the Schedule C. If we have a separate entity, it could be a partnership, it could be an S Corp, is generally what we see most commonly. They're going to have an actual partnership or a business return, and then we're going to get another form that's going to report our personal income and our personal reportable items from that entity and from those separate activities. And we've already mentioned a couple instances where this comes into play, but farm activities and the farm industry is treated a little bit differently for like income tax purposes, but we also see some other areas where it can make a big difference too. And so labor can be a significant challenge, a significant reporting requirement for really any type of business. But what we see with farm labor, and we're not necessarily going to get into all the details here, but for our federal unemployment and for our Social Security and Medicare taxes, the thresholds where we have to withhold and report that information is a little bit more lenient than those that are non-farm employees and non-farm businesses and activities. The other thing I would say in relation to that, sometimes if we've got a farm and we're contracting with, say, a custom labor group, it may be that we are sending a check to that group, and then the leader of that group is then they're employees of that organization. And so we are providing, say, a check, but they are really the withholding and the reporting requirements for those employees is part of that farm labor group. And they're coming out and doing, say, a custom harvest or custom processing or something like that for you. That's a separate calculation, or just something that that other entity is going to have to undertake, not necessarily your farm. We're going to touch on this a little bit more towards the end, but the property tax and sales tax, often our states will also give agricultural activities some favorable rates and things like that, but they also want to see, and that's where we see some parallels between the federal income tax and some of these other taxes. But I also think where some of the confusion comes in a little bit too, a lot of times our states will give some preferential rates and treatments to our true farming activities, but whereas the agritourism activities, they may be looked at as more of a commercial enterprise, a commercial activity, and typically they may be subject to more of those like sales tax and higher property tax and some of those things. And we're going to talk a little bit more about this throughout the presentation, but the record keeping, as you can imagine, one, it can be maybe a significant challenge, and it would be a good practice, whether it be a person involved, if you've got strictly agritourism activities and perhaps you've got someone doing the record keeping for that, or you've got someone on the farm and they're strictly doing the record keeping for the farm. But either way, we do want to have separate books and records for each of those activities. And I think that's true whether we're talking about, farming versus agritourism activities, or let's say just you and your spouse, you each have a separate small business. You would not want to intermingle those funds or intermingle those records, because it becomes a real headache and a real chore to separate out, well, was this farming activity? Was it an agritourism activity? And we already discussed we've got special provisions and rules in agriculture, and we want to be able to take advantage of those. But if they become sort of intermingled, the IRS may come in, start to ask questions. It may get a little bit hairy or like hard to explain if our record keeping is not sort of clear and precise as far as what those activities were. Already touched on this a little bit, but sometimes for property tax purposes and things like that, or zoning regulations, your local governments may have their certain rules and regulations that they want these businesses to abide by. So as we're doing this webinar today, I mean, we're speaking from a national perspective, and we're primarily focused on the income tax perspective, but having those separate books and records and then being able to clearly define what each of those activities are. And then they may want to see some of those forms like the Schedule F form to document some of your activities. But having that clear separation, knowing the differences between the two and being able to like show the differences through your books and records can play a big role in some of these other scenarios as well. And we already touched a little bit on some of the labor side of things, but we do have some different rules and regulations as it relates to farm labor and farm employees. We'll, I think, throughout the presentation, talk a little bit about, to the extent possible, we want to clearly separate all of these items. And so, in one sense, if you were to hire employees, I think it would be advantageous to, say, hire someone solely for farm activities, and maybe on the other side, hire them solely for, say, if they're running, they're an employee of the restaurant or something like that. But I'd say at the very least, have some way of tracking their hours if they are maybe between the two, between the farm activities versus the non-farm or the agritourism activities. And the marketing and branding can be important too, so that people recognize, and a lot of times we might have a separate entity as well, but being able to market and brand, like if you want your produce from the farm to be high quality and recognized, not just at the farm, but perhaps at restaurants and at the farmers market and things like that, you want to clearly brand and highlight that this is like Jones Farm and these are our products and those sorts of things. Whereas the agritourism may have a slightly different branding and marketing and things that you may do related to that. So you want people to come into the farm, you want them to have an experience, you want them to come for a field day or something like that. So it might be like Old Time Market at Jones Farm is having a farm field day. And that's a way that even through the records of the business, you can say, well, these were advertising and promotion activities related to agritourism, and not, it's a difference between that and what you might do for your true farm production. All right, and I think this was maybe where we were going to switch back, Rob.
Yep. Yeah, I'll pick it up here. So, as Kevin mentioned, I mean, we're looking at that topic of looking at the risks of improper separation, and again, we're talking about that ability to separate that farm portion from the non-farm portion. Now, we mentioned earlier that the farm income, it's important to be able to distinguish what that farm income is for purposes of possible income averaging, for estimated tax purposes. That might be applicable, might not be applicable. Soil and water conservation expenses. It's important to be able to separate those items out so that it's to your advantage to be able to get the advantage out of that if it exists. Now, right now, between IRS and state audits, it depends on your locale, but you always want to have a good set of books to back up that tax return. All right, and that's largely what we're talking about on this second bullet here. You want to be able to back those numbers up to avoid any potential penalties and underpayment penalties or interest because we misclassified something on the tax return. And you know, employment law violations, that's always important to make sure that we've got everybody classified properly on that. The and just to emphasize, and this kind of coattails into what I'm going to hit on the next slide, is farm labor gets reported on a form called a 943. All right, farm labor gets reported on a 943. You file it annually. If you have non-farm labor, that gets filed on a 941 and it gets filed quarterly. And at the same time, most non-farm labor is going to be subject to state and federal unemployment. Whereas there are exceptions to this, but most farm labor is going to be exempt from state and federal unemployment. So that's where this can get really, really complicated and messy if the books aren't really kept in very good order. So here's some best practices that we want to look at. All right, if appropriate, consider establishing some different entities for the farm portion and for the non-farm portion. Now, before the Q&A lights up, let me just say this for the record. If you've got a small operation, say it's grossing under $10,000, for instance, and you have no employees, I don't think you need to go out and set up separate entities. All right. Where, if you have a larger operation that's more complex and you have hired labor, I think you should consider possibly setting up some separate entities. Have one entity for the farm, have one entity for the non-farm. Ultimately, this all flows to your 1040, but what it does is it gives you a mechanism where you can reasonably keep everything separated out. All right. And that's a discussion that you really need to have with your accountant, or you rather should say your tax professional on that and see whether that's a case or not. We're not here to talk about liability or anything, but many of these entities that that we're talking about here offer some liability protection, and in an agritourism type of business, you're dealing with the public, you've got people on your land. The liability protection might be something that you might want to consider. And that's something that you need to talk about probably with your tax professional and maybe with your family attorney. So the maintaining separate financial records, that separate legal entity does help you do that. But if you have that small operation, even if you're running everything in QuickBooks, there's ways that you can keep those two separated. Still have one set of books, but you can keep everything separated in there. And other best practices, clear contracts and agreements. I am a huge proponent of paying attention to this, even in a small family operation. When I first came to the university 20 years ago, I was a field analyst for one of our farm management associations, and we had a saying in the farm management association: if it wasn't written down, it doesn't exist. And with regards to agreements, I couldn't emphasize that any more than what I already am. You need to have some clear written guidance on that. If you've got a family operation involving siblings or somebody other than immediate family, it's a good idea to have some contracts drawn up and agreements drawn up as to how the business is going to be set up, and most importantly, what's going to happen if and when it gets sold off or discontinues, because eventually it will. And it's also a really good idea to consult with those tax and legal professionals, especially folks if you're setting up a legal entity. Now, I don't want to sound like I've seen it all, because I haven't, but I've seen a lot. Now, setting up legal entities, as I'm about to talk to you about, please don't go online and do one of the online fill out the questions and send the people a check to set up some kind of a business entity. Go see a local attorney and get that thing set up properly, because one of the main functions of setting up an entity like that is for liability protection. And if you drew this thing up on an online tool and didn't have a lawyer look at it, if something bad happens and you get hauled into court, it's probably not, the suing attorney is probably going to find a loophole in there. All right. So it's just a good practice. That's something you don't want to cut a corner on. All right. Just do that. Be a consumer profession, be a good consumer professional services. All right. Moving on here. So as far as the activities go, we touched on the farm stuff a little bit earlier. Now the non-farm stuff, the what we'll talk about here, say like if we had that apple orchard example, the gift shop, selling the pies, selling jellies and all that sort of stuff, that would be a Schedule C type of thing. Or the experience. All right, if you're charging an admission and the folks are getting hay rides and all sorts of stuff, the only thing that's really going to be Schedule F is the actual sale of farm products, farm grown products. All right, so if you're selling the experience, service, a value added product, or if you got a craft show or something there, none of that's going to be farm income because it's only the farm produce sales in an manufactured form that are going to qualify as Schedule F. Those are going to go on Schedule C, and Schedule C is just a separate tax form. Goes on the 1040, and here, yeah, Kevin flipped this over. Here's just kind of a the right hand side shows kind of a screenshot of what Schedule C is going to look like. The instructions are quite lengthy, but and I wouldn't necessarily recommend that you just go dive into that right now. But ultimately, your non-farm income and expense get reported on Schedule C. You end up with a net at the bottom of the form, like you do a Schedule F. That number ends up flowing over to the Schedule 1 of the 1040. Schedule 1 kind of collects all the schedule amounts and summarizes that, and ends up going on the ends up on the front page of the 1040 is where it ends up. So it collects all that. Now, there is a small business tax workshop that this is an IRS video. There's a hyperlink here for that, and again, you'll be able to click on that when the PDF of the handout gets distributed on that. So the okay, one quick thing here. I think we can advance it here, Kevin.
Okay, and just as a quick comment here, so mentioned earlier about the Schedule 1 and just kind of being a summarization of our activities. So if you took a look at the Schedule 1, and I believe we might have it in one of these other slides, but that Schedule 1 on line 3 is where we see a summarization of our Schedule C activities. And so that, like that net amount that Rob was talking about earlier, you would see that flow through to that Schedule 1 of your Form 1040. And as we're going through this, I kind of meant to add a slide previously, but we also see in a sense where we'd have our farm production activities, and we might take our berries, for instance, and then we would turn them into a jam. And so essentially what happens, and this is recorded through the books and the records of the business, we have a sale from the farm, which is our Schedule F sale, and it becomes a purchase by our Schedule C business and an expense by our Schedule C business. Then we might have purchases of sugar, we might have labor hours and that sort of thing. And then once we're sold as a jam, that becomes a sale from the Schedule C business. So just sort of a kind of walking it through the process of here of how you might see some of those value added activities happen and kind of the interplay between your businesses and also these forms. And so I'll just stop there and we can continue on.
Okay, sure. Thank you, Kevin. Here's a graph that kind of helps. I guess what we're trying to do is visualize how this flows on the tax return. If you're operating as a sole proprietorship, there really is no differentiation between really the business and the individual. It's all one and the same. There's no separation between that. So on, the sole proprietor, farm income gets reported on Schedule F, the non-farm income gets reported on Schedule C, and it all ends up getting bundled up with the 1040. Those are all summarized. All the numbers end up flowing to that front page, and that's where the income ends up getting reported. So there is the point is there's no separation on this, and it all gets reported on your individual tax return. Now, if we flip to the next slide as we go through here, now what we have here is this is a 1065, which is a U.S. partnership return. And in order to have a partnership in the United States, you simply have to have more than one person. And you typically want to have some type of an agreement drawn up, but the partnership is going to file its own tax return, but partnerships don't pay any of their own tax. All right, the same thing holds true for S corporations, which is a really popular entity, also in the country right now. That gets filed on 1120S, and the same deal. If you have an S corporation, you don't pay any tax on the individual corporate. The corporation doesn't pay any tax. The income flows to the individuals on a K1. And let's flip to the next slide here. This is going to help graphically. Well, we get okay. One more slide, then we get to the graphs. Okay, if you're you go ahead and back up, Kevin. There. So if you're, what you're going to do is you're going to get a K1 if you're part of an S corporation or a partnership, and that where that ends up flowing to on your tax return is that's going to come through on the Schedule E on your individual tax return, which is good to know, but I think the global part of this that's probably the concept for everybody is on the next slide. Go ahead and advance that, Kevin. Okay, now most LLCs and partnerships are gonna follow this type of a scenario, and because what happens is the partnership or the LLC, most LLCs are filed on a U.S. partnership return, 1065. Now, Kevin mentioned earlier that you can have a single member LLC. That will get filed on a Schedule F or Schedule C on your individual tax return. It does not require the filing of a separate return, but that's if you are a single member LLC. Now, for multi-member LLCs and partnerships, those individuals are going to be filing the partnership or the LLC tax return. Most cases, it's going to be filed on a 1065. The 1065, you don't pay any tax on the 1065. What happens? You file the partnership return. And when you file the partnership return, there are K1s that end up going to each of the partners. Now, let's say, for instance, that this was a three-way partnership. Let's say it had three siblings were part of this partnership, and each sibling is sharing a third, and a third. All right, so everybody's getting a third of the net income. That K1 is going to go to each partner, and it's going to report a third of the net earnings from the partnership, and then each individual partner reports that respective income on their individual 1040. All right, this is what they call a pass-through entity. All right, you have to file the partnership return, and then there's K1s that are flowing that money through. Now, in the case of a partnership and LLCs, there's no self-employment savings or anything along those lines. It's it's just a pure flow through of money is all that's happening there. All right, there's no tax savings for self-employment tax or anything along those lines if you've got a partnership or an LLC. All right, let's advance that, Kevin. Okay, so an S corp. Let's look at the S corp, and again, the reason we pop this up here, S corporations and LLCs are probably two of the hottest entities right now that folks are getting into. The S corporation is also a pass-through entity, but and I'm not going to belabor this real long. We've got other materials out there on differences between LLCs and S corporations, and get a hold of us after the fact, and we can steer you to those resources. But the S corporation files its own tax return and it pays its own tax. The difference is S corporations, when that money flows through, you don't pay self-employment tax on the earnings coming out of an S corporation, but the S corporation has to pay a salary to those shareholders. All right, so that's where the self-employment tax comes in the way of FICA and Medicare withholding on those salaries that get paid to the shareholders in that case. But structurally, it's very, very similar. All right. So if you were to set up, I don't have a graph on this, but if you were to set up a couple of LLCs, for instance, or a couple of S corporations, one for the farm, one for the non-farm, uh, you'd keep the farm and the non-farm business separate on that, but all the K1s everybody would end up with two K1s coming to their individual tax return, and that's how the money would flow through. All right, and that would be what I would recommend for if you have a sizable operation. Now, from one final note here, and then I'm gonna go on this. If you're not real familiar with these business entities, I would strongly encourage you to maybe start with a partnership or an LLC first. There's less fiery hoops to jump through when you're doing that when you're doing that type of an entity. S corporation, you're getting into a corporate entity, and there's more paperwork, there's more stuff to file with the state, there's more everything. So it's a little more complicated. LLC might be the best way to start off, but that's a conversation you need to have with your accountant and your attorney. Okay, last thing I'm going to talk about here before I hand off to Kevin again for a bit is want to talk just some examples here. So coming back on this, let's say you had a U-pick operation with a farm store, and this is a common thing here in Minnesota, especially when you get to the get to the Twin Cities metro. You'll have somebody with a small acreage, and what they'll do is they'll plant you know they'll plant 4 or 5 acres of strawberries, and what they'll do is they'll allow families to come in, and then they pick their own. They buy the strawberries that they picked. Well, that ultimately is a sale of strawberries. So that's going to be the farm portion. But if they have a farm store along with that selling T-shirts, hats, maybe some crafts, maybe some jellies and jams along those lines, that's all going to be Schedule C. All right, the only portion of that you pick that's going to be farm income is the actual sale of those strawberries or whatever fruit that they happen to be picking. So if you got a farm, example 2 here, if you got a farm with an event venue and say a restaurant, um, you might have this could be perhaps an apple orchard or maybe a pumpkin patch or something, and they happen to have an on-site restaurant that's part of this, and the restaurant may not be real high end. It may end up being hot dogs and snacks and type of stuff, but sale the apples, sale the pumpkins, that's going to be farm income. But if when they're running folks through the restaurant, everything served up in the restaurant's been processed. If there's a gift shop that goes along with that, selling hats, T-shirts, all that sort of stuff, that's all going to be non-farm. The only portion of that that's going to be farm is going to be the actual sale of the pumpkins in this case. So example 3 is kind of a homogenation of the first two. A common example that we see around my part of the country is maybe the apple orchard. They're growing some pumpkins. It's a fun activity to go see. I've got three grandsons. We love to take them there in the fall. Uh, they do a hay ride. They've got some, they got some toys for them to play with in a playground type of area. But they're selling pumpkins. They're also selling apples. That's going to be Schedule F. But if you go to the gift shop and you're buying pies, jams, crafts, any of that other stuff, that's all going to be Schedule C, non-farm related stuff. All right, Kevin, let you take it away there.
Yeah, that sounds good. And we probably aren't covering all the myriad of scenarios that people probably have as part of their operation. And we could probably touch on some more a little bit later. But I think those are some great examples of trying to just separate and understand the differences between the two. But just being, I think, crystal clear about if it's true farm production, it goes Schedule F, and then any other type of like small business activities, it's really going to be more that Schedule C type activity. So even though this is not really a record keeping presentation, I think from what we've discussed so far, you could probably see how it plays such an important role in our reporting for tax purposes, and probably some other reporting and conversations that we might have, whether it be with lenders, whether it be with insurance, and all those types of things. They want to have a true and clear picture of what activities you're doing as well. So you want to be able to monitor the progress of your business. So especially if you're first starting out, you want to probably be able to see how much you've grown over time, what your profitability is, which crops maybe are doing well as far as profitability, which crops are not, but also understanding like, well, in total, we did pretty well last year, but how much of that was like true farm production and how much of that was more of like our agritourism activities. And as we said, we do see a number of farms start to incorporate these activities into their overall activities during the year. But for tax purposes, it's reported differently. We want to understand the differences between our different enterprises, and hopefully you as a manager, not just for tax purposes, but hopefully it serves you in these other areas as well. So being able to prepare your financial statements, understanding where your sales are coming from, what your major expenses are, keeping track of those like labor hours for employees that you might have during the year. All of those things are going to be supported by and helped by good records for the business. And so many of you may already be at this step, but would encourage you, if not, that one of the first things you want to do is separate business bank account, like set up a separate business bank account for any small business activities that you might have. So it's really the first step to good financial records. A lot of times, if you're already banking with someone from a personal standpoint, they're probably going to have a business account that would be fairly straightforward and easy to open if they've already got your information on file and things like that. They may request your EIN, your employer identification number, which is something you get through the IRS, and then you would provide that, whether it be for your Schedule C activities or your Schedule F activities. And then all of your transactions are going to be run through this account. And if you're a sole proprietor, then it would just be like you as owner and operator of the business. And so you're wanting to keep your personal separate from your business information, but perhaps you are including, say, other family members, or you're part of a partnership and you're all together on like that business account, but making sure that your family members or your other business partners, they're crystal clear too about what activities are, say, Schedule C, what activities are Schedule F, and that those are being correctly run through those business bank accounts so that we have good record of all the different transactions that we might have during the year. So it's keeping our personal and our business separate, but it's also keeping your business and maybe your second business, your agritourism versus your farming, it's keeping all that information separate as well. And really, this says for a farm record system, but we could say like really any type of business records system. We want to understand what's our income, what are our sources of income, what are our expenses, especially maybe our significant expenses, and is there a way for us to manage those in the future? Like, can we produce these items a little bit cheaper or something like that? But we also know that there are significant transactions we might have during the year, whether it be purchasing pieces of equipment or land or something like that. And typically we're going to have loans and times that we're going to need to find financing for those things. All of those are going to be treated a little bit differently through the books and records, but especially for tax purposes, we've got to keep track of what's our actual income, what was times where we borrowed money, what were times where maybe the owner contributed money to the business, and those are all treated differently for tax purposes. And so that separate business bank account is going to keep a tally of money for the business. So even from like a cash flow perspective, that's going to be important, because if we've got different items that we've got to pay during the year, we need to know what our situation is from that standpoint. Most small businesses are cash basis. Like generally, if you're under a certain amount of revenue, and most, I think it's like $30 million or something at this stage, but if you are under that threshold, then you are able to be considered a cash basis taxpayer, and that's different from an accrual basis, and we won't really get into that today, but that just means anytime cash changes hands, that's when we're recording a transaction through the books and records of our business. And we'll have the bank records of each time, say, a purchase was made or a sale was made, and then we want to input that into some kind of a ledger for the business. So that's just a bit about record keeping. And then for our overall tax return that we might file, which again is going to come from those books and records of our business, but also we're going to have some other personal items that are going to affect that. And agritourism and farming is going to be one part of our overall federal income tax return, and we've already touched on some of the forms that are feeding into that comprehensive report or return that we're going to file. And we mentioned the Schedule 1 and some of the other activities that we might have, but it could be that especially if you're first starting out, your agritourism and your farming might be a relatively small portion of what your total income is for the year. Or perhaps if you've been doing it for a while or you've really scaled up over time, it might be a rather large portion of your taxable income for the year and really affects the rates that you pay and that sort of thing. But for instance, you might have, we've talked about farming and agritourism. You might have other businesses that you're running, in which case you might be getting like a Schedule C or a K1 from some of those activities. You might have off the farm income, be it you work, say, a salaried job for maybe it's a business in town or somewhere else completely separate from the farming activities, or your spouse might have an off the farm job, like a job in town as well. And then lots of times people may also have investments, or perhaps they've got rental properties. And this is not all the types of income that we may have, but just to mention a couple of those other things. And all of that income in total is what's going to make up our federal income tax return. So just to mention it briefly, really our goal is that we maximize our after-tax income. And so we want to understand what our effective tax rate is for the year. And we can certainly manage some of our activities, whether it be from an agritourism perspective or from a farming perspective. We may decide that, okay, from the farming standpoint, we're going to take additional depreciation or purchase equipment or do income averaging or something that's going to help us manage this tax bill, because we've got our farming activities and we've got these other activities that we may have reported high income for the year. Those are things that you can kind of calculate, again, from your books and records of your returns or from your books and records of your business. You can calculate some of those things. If you're working with the tax preparer, they can help make projections for you and things like that. And that's where you may decide that, income averaging would really be beneficial to you, or some of the other special provisions that we can take advantage of. But understanding kind of how these things work together, I think, is part of that larger conversation. So as part of that, if you wanted to figure out what your effective tax rate for the year, and sometimes I have a slide on kind of the tax brackets, but you could look those up for 2025, for instance, to see where your different levels of income fall and what rate gets applied to that. But if you wanted to see what your effective tax rate was for the year, if you go to line 24 of your tax return, so you could do that for 2024. We really just got finished filing those, in about the middle of April, so about a month ago. So if you go to line 24 of that return and you divide it by line 15, it will give you your effective tax rate for the year. So it might be, certainly it's going to depend on how much total income you have. It's going to depend on not necessarily the sources of that income, but it could depend on whether it was capital gains, for instance. It might depend on whether it was a lot of self-employment tax, or just, we had a number of different items come in during the year. We had rather large portion of income and we got higher rates applied to that income. But for instance, you might take line 24, divide it by line 15, and it might say 15% was your rate. And so you might compare that even to the previous year and understand, was 15% what we hit in the previous year? Was it higher than that? Was it lower than that? And then going forward for 2025, maybe compare that again before your return gets filed, or just in the fall of the year of like 2025, say in September, October, we might take a look at it and see, are we in a similar position as that? Are we a lot higher? Are we a lot lower? And what's affecting that? So that's just a bit about tax management, just kind of understanding your rates, understanding what's affecting that. And again, agritourism and farming might be a big part of that, might be a small part of that. Each person's situation is going to be a little bit different. And then self-employment tax, we thought this was important to touch on too, because if we're talking about these Schedule C and these Schedule F activities, they're going to be subject to self-employment tax. And so if you are in business for yourself, be it farm or non-farm, you are considered self-employed. And so if you have $400 or greater of self-employment earnings, then you are going to file the form and you're subject to self-employment tax. There's a 15.3% rate that gets applied to your self-employment earnings. The Schedule SE form is where those earnings get reported, and then the calculation gets made. And just as a sort of a quick explanation, or try to be quick explanation of this, if you've worked an off the farm job and you can see, say, on your W-2 where you had your gross wages, and then you'll see that certain portion is taken out for Social Security, certain portion is taken out for Medicare, it's 7.65% is what gets taken out of your wages. And then the other half is paid by your employer for a total of 15.3% of your earnings that is then paid as self-employment tax. So part comes from you, part comes from your employer. But if you're in business for yourself, you are now paying both portions of that tax, both employer and employee portions. So the form, you can find that within the IRS website. You can find the instructions for the form. It's 6 pages, and it tells you what is includable as net earnings from self-employment or what is not included as net earnings for self-employment. There's also, as part of that short video series, they have a video on self-employment. But as the instructions state, it's going to be our incomes from Schedule C, Schedule F, 1120S, which is our S Corp K1s, and our partnership K1s. The QJV is a qualified joint venture. We didn't really talk about that today, but that's if spouses are in business together. It's a kind of a separate little entity or classification for tax purposes. If you have multiple businesses that are subject to self-employment, you could combine, let's say, John Jones has 2 or 3 businesses that he is running and that are subject to self-employment, he can file one Schedule SC to compile all of his self-employment earnings, and that's reported on the one form, and then the calculation is made for his self-employment. Let's say his wife, Sally Jones, also has self-employment from, maybe they're in one business together. It might be a farming business, but she also has a separate, say, banking business, or she does payroll services, or she does bookkeeping on the side or something like that. She needs to also fill out a Schedule SE for all of her self-employment earnings. And you want to report those separately. And for each, like if it's married filing jointly, taxpayers, they're each going to report their self-employment tax. Now they can combine theirs in total, but they each need to file one of those forms. You are allowed a deduction for half of the self-employment tax that was paid. So essentially that employer portion you get a deduction for, and that goes to line 15 of the Schedule 1 that we've kind of referenced a couple times through this presentation. So you can take a look at that. Again, perhaps you had some of these affecting your previous tax returns. Hopefully you'd be able to follow that through the different tax forms. And so just to mention this, so Social Security could be important, especially as we get up to retirement age, or perhaps there's a disability or something like that that happens. It depends on how much we've paid into the Social Security system. And so in order to receive retirement benefits, we have to have what they call 40 quarters of coverage. You can earn, as you'd imagine, 4 quarters per year. And so if we need 40 quarters, that means we've paid into the system for 10 years. And that's what that calculation, the SE form, is calculating. And then we are filing that form and filing our self-employment according to our earnings. And so retirement is 40 quarters of coverage, disability is 20 quarters of coverage. If for some reason a spouse passes away, there are some benefits in those situations too, but it kind of depends on a couple factors as far as when the benefits kick in. We already mentioned, like, if you have, let's say $400 or greater from self-employment, that's when we see those that form and the tax kick in. It could be that there's times where if we're a farm, we might have low income, but we still want to pay into the system so that we can receive coverage. There are optional methods to pay self-employment tax, even if in a particular time period we had low or little to no income, but we still wanted to pay into the system. And there's a farm and a non-farm version of doing that. And we're primarily focused, obviously, on the federal income tax, but just to mention it briefly here, not all states have a state income tax, but a large majority do. If you are subject to state income tax, often they're going to take what's calculated for your federal tax. And that includes all the different, say, forms and schedules that we've kind of mentioned throughout the presentation. But for instance, at least for our state here, but many other states are similar, they're going to take those schedules like the C and the F that we mentioned. They're going to be includable as part of the return, and they base the state return based off what you file for federal tax purposes. So I think that's where having a bit of an understanding how some of those federal forms work, knowing, that it's based on all of our books and records of the business, and then that feeds into what gets filed for state purposes as well. If you'd like a bit more information, the IRS does have a good listing through their website of the different state entities and things that you might be dealing with, but also how to find some more information about some of those taxes that you might be subject to. Oftentimes we do see, like, it might be states, it might be counties, it might be towns, that they might also require a business license to operate. And essentially, these kind of work as a tax, even though they're called a business license. It's almost a tax for those entities or those activities to operate during the year. So this is really dependent on your particular locality and those sorts of things. You really need to, we wouldn't have that information on hand, but check with your local government as far as what you're subject to. Often though, each of those activities will need a separate license. So if we had like agritourism activities, they're going to need a separate business license versus our farming and our agricultural production activities. Typically, these are going to be renewed on an annual basis. I wouldn't say they're, haven't heard of any that are really high. I mean, typically it might be $150 a year or something like that. But in essence, it's almost a tax for you to operate within that locality. Same thing for sales tax. And we really just wanted to mention these because I think when you work in this realm, you start to be subject to some of these, and some people get them a little bit confused between maybe what's state versus federal and what some of the differences between some of the state taxes are. So sales taxes, not all states can still have sales tax, but often agricultural production will be sales tax exempt. So we're talking we've produced an item from the farm, be it livestock, be it vegetables, be it crops of some kind. Oftentimes they are exempt from sales tax. But when we've turned that product into, say, a value added product, or we're selling prepared foods, like they've come to the farm as part of a fall field day, or we're selling a ticket as part of their entrance onto the farm, those items are going to be subject to sales tax. So there's a little bit of parallel there in that we've got our farming activities that are reported on Schedule F and not typically subject to sales tax, whereas our Schedule C activities, they are, other like agritourism type activities, and they are subject oftentimes to that sales tax. But again, kind of depends on your location, and kind of same thing that we see for property taxes. So many states offer a lower property tax rate on agricultural property, and that its main purpose is for agricultural production. And they say, they want to sort of recognize the agricultural production in that area. They want to encourage maybe agricultural production in that area. It provides some environmental protection. And so there's different reasons why they might incentivize that. And those tourism activities are not really, again, based on farm production. And so they're often not able to have those same favorable property tax rates if such a thing exists. So there is some almost like gray area sometimes, because you might be using a field for true production activities, and it might also have a portion that's like an agritourism portion. I think most states take the thought that if the primary use for it is considered agricultural production, and the agritourism is like a subject use or an accessory use, they might call it, then you may still qualify for those more favorable property tax rates. But again, we're just speaking from a larger perspective, like a more of a national income tax perspective, federal income tax perspective. But we see these issues and these questions pop up, so we kind of wanted to point you in the right direction on some of these. And the National Ag Law Center, they have really a number of helpful articles and those sorts of things, but I did see they have a resource as it talks about some of like the property tax rates and how those are determined, with a number of references for different states throughout the United States. So that might be something you want to take a look at. And we've got just a couple slides here, and then hopefully a couple minutes at the end for questions. So I'll turn it over to you, Rob.
Okay, yeah, and very likely, Kevin, we're going to go over a couple minutes, but just hang in there, folks. We'll stick with it here. So essentially, what we've got here is we wanted to do a little bit of discussion on some record keeping. Now, this could be a much more detailed discussion. We're just going to have a couple slides on that, and that's pretty much it. Now, there's a lot of different options for record keeping systems, and now is not a bad time to be thinking about that, folks, because odds are, unless you got payroll, a lot of folks haven't even touched the record keeping for 2025 yet. I mean, they were focused on trying to get everything together for filing the 2024 tax return. So manual record books, believe it or not, I'm going to hold up a couple here. I mean, this was one that that was put out by Farm Service Agency. Now, this one's got a little bit of age to it, but I did pick this up at the county office a couple of years ago. So they still may have those stockpiled over here. I've got another one that I get from a professional organization that's kind of designed along the lines of the Farm Credit Record book from the late 1970s. So they're still around. The only thing that I don't like about the manual record books is just that computer software is easy because it takes about the same amount of effort to get the stuff into the software, and then you can add, subtract, and do whatever you want to for report generation. Now, uh, the there is an Excel spreadsheet that's on the slide here from Clemson, and Excel spreadsheets are a good tool to use for record keeping. The only cautionary note that I would say on that is I'm a big proponent of reconciling the bank balances back to the bank statement every month, and it's a little harder to do that when you're sitting in a spreadsheet. It's probably easier to do that with software. Kevin, why don't we advance it to the next one here? I'm going to talk through this really, really quick. Now, there's some, Kevin has some free-ish programs up here, this Zero, Bench, and Wave. The record-keeping programs that are also out there, QuickBooks and Quicken. Now, I've had folks with the Farm Management Association that have used QuickBooks. It's a good accounting program. It's not a farm specific program, but it'll get the job done. QuickBooks is not cheap. They charge by the year, but there's an annual fee that gets tied to that, and I don't think you can even get into that for under $300 a year anymore. Now, ag specific programs. The one on this list that I'm most familiar with is PC Mars. That's the program that we recommend to all our farm management people when they join the association. It's a farm specific program, allows you to track numbers, weights, bushels, and it spits out a really nice report. It's easy to use, and it has wonderful training material. You can get into that. I think the base program is $75 a year, and it's been around for over 30 years, so it's got a lot of longevity with it. Also consider a paid bookkeeping service. Just pay somebody to do it, send your cancel checks in, and let them look at it and process it for you. So with that, that kind of wraps up what we've got. I think what we're going to do is we're going to spend some time here on Q&A. I'm pulling up, let's see here. Nothing in the chat that we need to look at here. So just let's get this pulled over here and look at these. Okay, I'll just take the first one here. I'll take a few of these and then you can jump in here a little bit. Kevin, I suppose we'll just tag team these a little bit. If you have an ocean orchard and you crack and peel pecans, is that farming? That sounds like farm production. So yes, that would be farming. And sale of value added products isn't considered farm income. No, value added, if you're doing any kind of processing to the product to refine it or anything, the only exception to that is bottling up honey. I mean, that's the only exception to that. If you're doing anything to that thing to process it or manufacture it into something else, that's not considered farm income. And is honey considered a farm crop? Yes, it is considered a farm crop. And do the concepts covered in this webinar also apply to livestock agritourism? Yes, essentially it would. Your farm income will be the sale of the livestock. And but now the one thing that I will caution you on is if you are if you're butchering and cutting up and packaging up the meat and everything, or you're paying somebody to do that, you are selling a processed piece. So if you're selling cut up meat in packages, that's Schedule C. If you're selling the animal off the hoof, that's going to be Schedule F. And that's how you would differentiate that.
And I didn't know if they were even talking about maybe like a petting zoo or something like that.
Uh,
Um, as far as livestock agritourism, that would also be though like Schedule C if they're paying for a ticket to come in for the petting zoo or something, also be agritourism or Schedule C activity.
yes. And I had a question here on a hunting lease considered agritourism. Absolutely. That is not farm. That is not farm. Uh, let's see here. How about I take the long one? Let me read the long one, Kevin. You want to take some of them down below here?
Yeah, sure. Um, how would you categorize people paying to work on an aquaculture farm? Um, trying to think because you're saying they are paying you to work on an aquaculture farm or you are paying them to work on an aquaculture farm. But if it's true farm production, then they like we do see where people are commercially raising fish or commercially raising shellfish or something like that. That is considered farm production, for instance. Does fishing count as agritourism? Is there a threshold of what you have to make to qualify as a farm and do your taxes that way? So fishing, like somebody is maybe paying you to come onto your property and to fish. That is not farm production. It's not reported on Schedule F. Is there a threshold of what you have to make to qualify as a farm? Not necessarily a threshold, and we didn't really talk about it here. I think some of our past webinars have talked about it, and there's a number of educational materials out there, but just the differences between like a hobby activity versus a for-profit activity. There's not any size requirements, there's not any revenue requirements, but for instance, for tax purposes, the IRS would want to see that you're operating your farm for profit. And there's a test of 3 out of the last 5 years did the activity make a profit, or they start to look at these other factors like was it managed in such a way that the owner appears to be serious about the activities, like keeps good books and records, goes through and creates a separate entity, manages the activity, spends a significant amount of time on it, and several other factors along those lines. Essentially, they just want to see that, and it doesn't have to be your sole motivation, but that you do have an intent to make a profit from that activity. And then, so if we're talking about farming, you have some kind of agricultural production and you're wanting to be for profit or have a profit motive related to those type of activities.
Okay, I'll take the one here. How long do I need to house an animal before sale? For example, if I buy partly grown poultry. Now, so normally you're going to buy pullets or something along those lines, and you grow them into market sized chickens. Uh, there really is no timeline on those because poultry grows so fast as it is anyway. The only thing I would probably avoid on that is, you don't want to buy them and then turn around and sell them the next day and call it farm income. As long as you've got some production time in there, that's kind of reasonable and proper.
Yeah, and then this next one, a plant that's considered a weed but is used for medicinal uses, like wood, drying the flowers and selling them, or could you sell seeds from the plant? Um, it doesn't sound like in my mind that you're doing a lot to that plant. You're basically harvesting it, maybe letting it dry out for a bit and getting the seeds and then selling those. That sounds like farm production to me. If there were significant processing activities, it might start to look a little bit differently, but that sounds like farm production to me.
Agreed. Agreed. There's another question here. What about seeds? If it's seeds directly from your agricultural production, that's going to be considered farm. Like if you were growing sunflower seeds for it, if you're growing sunflowers and selling sunflower seeds, that's farm income. All right. Is beeswax considered a craft item? Um, in its raw form, it's going to be considered farm. If you're doing anything with it beyond just packaging it up and selling it, it's going to be non-farm. And that may not be answering your question, but that's how we differentiate that.
Not entirely sure if I'm clear on that last question, but is selling livestock on the hoof that is processed on site Schedule F. So it almost sounds like you've got the farm production and then separate processing that is also on site. So I think I kind of mentioned an example earlier where your farm may sell to your Schedule C processing activity, and then the processing activity would make a further sale from there. So you would almost have a purchase from the Schedule C, from the Schedule F, the farming production, and then a further sale once it's been processed into, like, say, additional cuts, then that's being sold from the Schedule C activities. If I'm unclear about that, you can send additional information or send us an email.
No, you're dead on with that one, Kevin. That's correct. It'd be an inter-farm sale.
Just briefly, we'll include our contact information, but we'll include these slides as well. And feel free to reach out to either one of us. We appreciate partnering with the USDA. I know many of the past webinars, it seems like, have been a big help maybe to folks, and hopefully this one as well. We thought it was like somewhat of an untouched topic so far, so we hope that just kind of making clear to the separation of activities. And I think we've seen a big interest in agritourism, and we'll probably continue to see a big interest in agritourism. So hopefully getting some information out there will be helpful, and we might further develop an article or do a second webinar or something like that based on some of the feedback. So I hope that was helpful. I'll stop there. I don't know, Rob, if you have any other follow-up comments.
No, just again, want to thank USDA for supporting this educational effort, and appreciate their support. And we'll our contact information will be in that PDF that will be sent out to all the registrants. Feel free to reach out. Well, feel free to reach out to either one of us, and we'll be happy to answer any follow-up questions. So Sarah, any concluding?
No, I was gonna say thanks everyone. I know there were some folks joined late. Just a reminder, this recording will get captioned and posted on the farmers.gov YouTube channel and also on farmers.gov/taxes, and the slides and everything will be there, and participants will get an email when all that's available. So thanks everyone, and have a great afternoon.